Is the US yield curve inverting, negating the October low? Let's first look at the long-term charts of US 10-year yield since 1968 up to now. Surely from 1982 down to 2012 to 2016, we have a downtrend. You even notice that we have twice a bottom at 140% about. And now that we are back to the previous top, 3%, which is also where the trend line is going through. Notice then the momentum here on a quarterly basis is overbought. That means that probably there is going to be more sideways action here. And here comes the trick. On the top part of the chart is the yield curve inversion, namely the difference between the 10 years and the 1 year. And we notice that it is getting close to the 0 point. And this is making all the angst in the equity market recently. People are afraid that an inversion of the yield curve would soon announce a recessionary time and that the equity would have to correct on the downside. Let's look quickly now monthly what's happening. In fact, the uptrend is well established with higher highs and higher lows. And a normal pullback from 325 to 280 would be nothing than just something normal. A normal correction, a normal pullback before the uptrend resumes. You see also that the influence of German rates is having its toll on US rates, and that's why also short term it is pushing back a little bit the US long-term yield of 10 years. Now, you notice here also on the momentum side a bearish divergence, which explain and reinforce the fact that probably the rates are going to hold between 325 and 280. Now, what has it for an impact on the US sectors? Well, if yields are coming down, that means automatically utilities are moving up. And that's exactly what we see here with a break up of the utility sectors. And here the relative strength in orange between the utility sectors versus the S&P is rising. Also, conversely, the financial sectors is doing bad because an inversion of the yield curve is bad for banks. But let's look a little bit more closely here. We had the October lows already in place, and what we've got is here just a training range between a top here of the top of the cloud and probably some bottoming action here as shown on with the different arrows here. So even though we are here in the momentum on the neutral side, it does not exclude at all a rebound from mid-December on. And the other casualty that we got yesterday is of course the industrial sector. Why so? Because just on the weekend we had some news about the tariffs, and then on the Monday we don't have all the details, and the market is a little bit upset by the fact that all the details has been fixed about the tariffs. So industrials, which are going to be impacted by tariffs, are kind of correcting back from the top of the range to the middle or the bottom of the range. It can go to the bottom of the range and then rebound. That's no problem at all. Still, that sector is going to be impacted longer term, and it remains a weaker sector in the sense that the relative strength versus the S&P 500 is coming down. That's the orange line here. Other casualties, and because people are thinking about 2007, 2008, when commodities were declining, and it came with the big structural recessions, if you wish, and the structural financial crisis. People did not like at all the fact that the oil price went from 75 to 55. But look, it's already bottoming somehow. And of course, the US sector is not doing too well. The relative strength is coming down. And that's not a sector probably to be invested in right now. But it is closer to the bottoms than to the tops. And because it is closer to the bottoms, it's not automatically going down the drain to much further lows like we had in 2016. Materials, of course, which represent commodities, also are also not in a good shape, and is also a sector to avoid, for the same reason as the relative strength is still in a downtrend. But now, if people are afraid of a kind of a recession, what do they do? Usually, they would go in defensive sectors, and that's exactly what this black line is telling us. That's a ratio of cyclical discretionary versus staples, which are defensive. So the ratio of offensive sectors, growth sector versus defensive sectors, and that's going down. But look, we already have made a bottom, and now just the little correction that we had yesterday is not really producing a new lows in that ratio. So let's not be too negative for two reasons. Number one, if you look at the relative strength of these defensive sectors like staples, you notice that in the last 2 weeks, instead of rising, they are going sideways. That means that now less and less people are buying these defensive sectors. If you look at the healthcare sectors, it had been going so well up on a relative strength basis, so far from its uptrend, that is probably overbought. And that's probably what we see here with the pullback of yesterday from the top of the range is probably going to migrate to the middle of the range. So if people are not buying the defensive, are they really buying the old leaders, namely discretionary and technology? Somehow they are starting to come back to it. It's not very strong, but it's showing some premises, and we see the relative strengths doing some bottoming actions and rising a little bit recently. So as long as we hold this trending range, basically we are going to hope and bet on the fact that from mid-December on, going through into the year, the rebound will be seen as along these different arrows toward at least the top of the trading range that we have seen recently. That's not asking much, and we have exactly the same picture for the technology sector. So here, again, we should remember that with the lows that we made 2 weeks ago and that we commented in detail that time, we had a bullish divergence. That means that the momentum was slowing, on the way down was slowing, and the reversal could come up. And look, on the S&P as a whole, from the date we made the last presentation, we had a nice rebound, and now we are just pulling back half or 2/3 of it. And that's not yet really a catastrophic event. Why do we say we are so positive? Because basically we should remember that we are on a weekly basis still above the long-term clouds, around 27, even though we are hovering up and down above the 200-day moving average, which is 2760. We should remember that probably we are going to make a higher lows also in December, and then moving up towards the old highs later in the first quarter of 2019. Finally, in the US, there is also the US currencies. And what we notice in this very crowded chart is here the US dollar index, which is making a kind of a double top here. That's probably going to evolve more sideways, given the momentum that we have here. And a US dollar which is going more sideways is in fact good for the relative strength of emerging market versus the S&P 500, what we see here on the upper panel in orange. And also is going to be good if the US dollar goes sideways for commodities, as there is an inverse relationship between the US dollar and commodities. That means that commodities could also do some bottoming action. So again, the US dollar is here also indicating not to panic, and we are looking forward to this bottoming action further.